we often see stable value as a single investment option in the plan, but it could also be used as a building block within custom models, managed accounts, or other programs designed to improve retirement outcomes.
This is 401k Specialist Editor-in-Chief Brian Anderson, and this is the 401k Specialist Podcast. Today, we're going to dive into what's happening with stable value funds, the low-risk investment options that are especially popular with 401k participants nearing retirement because they are designed to protect principal while earning a steady return. We're going to talk about it with Lincoln Financial's Matt Condos right after this brief message.
Brought to you by Lincoln Financial, a premier provider of stable value solutions, offering risk management expertise, financial strength, and attractive contract provisions for over 40 years. The Lincoln Cornerstone series provides competitive, stable value investment-only solutions that use a multi-manager framework, leveraging the expertise of external managers for analysis and different market perspectives. They can be customized for each client, including net rate, guaranteed minimum interest rate, and more. To learn more, visit lincolnfinancial.com/SVIO.
Here today to give us the lowdown on stable value funds, we're happy to have Matt Condos, Senior Vice President at Lincoln Financial. More specifically, he leads a team responsible for product development and management across Lincoln's defined contribution retirement business. Drawing upon more than 25 years of experience, Matt provides strategic direction to a team of roughly 100 dedicated professionals to deliver and service innovative solutions for plan sponsors, intermediaries, and participants. Welcome to the 401k Specialist Podcast, Matt.
Thanks, Brian. And I really appreciate being here and certainly applaud you for covering such an important topic.
All right, well, let's get right into it. Matt, how does Lincoln Financial view the role of stable value products in today's retirement landscape, and how can they be an asset to a modern retirement plan?
Yeah, so I've seen how market volatility and investment performance in recent years have really re-emphasized discussions across the industry regarding appropriate asset allocation strategies, diversification, and the need for principal protection within a DC plan participant's account. The three main constituents in the ecosystem, that being plan sponsors, plan participants, and their financial professionals, have reacted to market volatility by increasingly looking to use investments that seek to add stability, liquidity, yield, and principal protection to retirement plan portfolios. And of course, risk tolerance will vary across these constituents, but many retirement plans could find value in having some level of stability and protection in an investment portfolio. So, for example, we often see stable value as a single investment option in the plan, but it could also be used as a building block within custom models, managed accounts, or other programs designed to improve retirement outcomes. And then my last point is that stable value investments can also be used as a source of retirement income. And so fiduciaries could take that aspect into account as well when incorporating them into their plan. We've seen interest pick up recently, and several new product introductions across the industry are designed to specifically address retirement income. You know, it's really an interesting phenomenon, as stable value has always had capabilities to be used for retirement income, but it wasn't largely utilized for that purpose in the past. Now, however, with a greater focus by the industry and clients on helping participants generate retirement income, we've seen renewed emphasis on this feature.
Right. Interesting. You mentioned risk tolerance. What would you say to a plan sponsor worried about situations where stable value returns were lower than, say, money market rates?
So I'd start with that sponsor by first acknowledging that stable value products and money market funds are different investment vehicles. Money market mutual funds hold very short-term money market instruments and are available for tax-qualified retirement savings plans, IRAs, and other savings accounts. Just like stable value, they can provide current income and stability of principal. But although money markets seek to maintain a value of $1 per share, they don't have guarantees and aren't covered by federal deposit insurance. Participants have daily liquidity based on plan provisions, and performance is based on short-term securities such as certificates of deposit, commercial paper, and treasuries. So although they are similar to stable value in some ways, there are key differences. And then I'd follow that up with some historical context for the plan sponsor. Stable value funds have been shown to outperform money market funds over the long haul, and there's several industry studies to back this up. There's been a few instances where money market yields have outpaced stable value crediting rates, and that generally follows a spike in short-term interest rates. Now, stable value funds are designed to amortize sudden interest rate changes over time, which can result in lower crediting rates compared to money markets at that particular time. Crediting rate methodologies smooth the impact of interest rate fluctuations and investment returns over time to provide a steadier return to investors. And that's intentional. This allows stable value funds to invest further out on the yield curve than money markets, and in normal interest rate environments, capture higher yields, all without any material increase in volatility relative to money market funds. Overall, this approach favors stable value when interest rates are falling, but can lead to underperforming some money market funds when short-term rates shoot up quickly. So to wrap this up, I'd ask plan sponsors what their ultimate goal is and how do their participants utilize the plan's investments. Are they seeking a steady investment that provides growth and stability over the long haul, or do they want something that more closely mirrors the current interest rate environment?
Right. Well, I've heard that some plan sponsors and participants have transitioned to money markets when their yields were higher, which drove some outflows from stable value. So, is there a risk to the product if there are too many withdrawals?
Yeah, along with the industry, we've seen withdrawals occur in those instances when money market rates have been higher due to a spike in short-term interest rates. But historically, that's been short-lived, and participants tend to revert back to stable value when yields normalize. During those times when money market yields outpace stable value crediting rates, though, it tends to drive market values for stable value portfolios below their book value. And in that instance or that environment, a stable value fund could be forced to sell some of its assets at a loss to meet redemption requests. And that in turn could negatively impact future crediting rates.
All right. So, what should financial professionals be aware of in these situations?
Yeah, so first I'd tell them it's crucial to revisit your client's stable value solution and understand the current positioning of their stable value portfolio. Some questions to ask include, what is the current crediting rate? How are the underlying investments doing? What is the market to book ratio, and how does that impact the plan's overall termination options? This is particularly important if a record keeping provider change is on the horizon or if the client wants to exit their stable value option. And these transitions can sometimes trigger specific events or require a fresh look at the existing stable value arrangements. I've seen a few times that a common misperception is that stable value functions just like any other investment when swapped out for something else. While many aspects do and are very similar, the financial professional can really demonstrate their value by synthesizing relevant information from the stable value provider to their client so that everyone approaches any change being fully aware. And then lastly, knowing the specifics of the contract, including any market value adjustments or put provisions, will be key during such a process.
All right. Now, I'm wondering if you can explain what a put provision is and how they come into play in this scenario.
Yeah, certainly. So put provisions help stable value providers manage withdrawal risk while still guaranteeing that plan participants can access their principal and accumulated interest at any time. If the withdrawal is initiated by an individual plan participant, most guarantees hold even if the fund's underlying investment assets are trading below the contract value. The put provision is really for sponsors and advisors to understand, as it generally applies only when the stable value option is being removed entirely by the plan. Puts weren't really an option for most of the 2010s when stable value investment portfolios generally held above book value. But most market to book ratios sank below 100% in early 2022 when the Federal Reserve began raising its target for short-term interest rates to check inflation. So since then, put provisions have been an important consideration. The provision invokes a time period which delays the full contractual payment. This is described in the contract or agreement between the plan and the provider and typically outlines a 12-month period or longer. So the plan ultimately gets the payment, but the timing can come as a surprise to plan sponsors if they haven't thoroughly reviewed the exit clauses of their stable value contract before terminating.
All right. Now, so how has the market responded to the new attention being paid to put provisions?
Yeah, in response to this growing attention towards put provisions, some providers, like Lincoln, are now offering shorter duration products with shorter payout options. The crediting rates reflect multiple factors, including the returns generated by their underlying investment portfolio, adjustments for any market value fluctuations, and costs associated with insuring and managing funds. Because of their short durations, these products may over time offer higher returns than other stable value investments with longer durations when the yield curve is inverted, but the trade-off is lower returns at other times. And in exchange, plan sponsors and their participants get an investment with greater plan level liquidity and a more transparent crediting rate mechanism. But I don't want to lose sight of, the traditional stable value funds with 12-month puts. Those could still make sense for many plan sponsors. They hold appeal for sponsors who have no intention of undertaking a plan level event, which could trigger withdrawals from their fund, or who simply wish to take advantage of a longer duration investment portfolio that could, over time, allow for higher returns to plan participants. So in closing, I'll wrap this one up by saying the new funds being offered can provide an appealing alternative to sponsors who are prioritizing liquidity and transparency.
All right. Well, you've covered a lot here already, but let's close out by talking about what advisors should look for when recommending a stable value product for plan sponsors.
Yeah, there is certainly a number of things to consider. The first is choosing the stable value solution that's best for a sponsor and plan participants requires analysis of the different types of stable value options available, and then a thorough comparison of the features across providers. It's important to document the process, and there is no requirement that I'm aware of to choose the lowest cost nor highest yielding option. So for the big picture, there are three main types of stable value investments, and it's important to understand their differences. First, there's guaranteed insurance accounts. Whether structured as a general account solution or a guaranteed separate account solution, they represent the oldest and largest segment of the reported stable value market. These options generally feature a guaranteed minimum interest rate, also known as a GMIR. So you may see or hear that acronym thrown around from time to time. They also feature crediting rates that are often announced in advance of a set period. The next category are separately managed accounts. These are typically focused on larger plans that have the size, scale, and desire to work with a stable value manager and wrap providers to customize a solution for their plan. And then there are collective investment trusts, or CITs. These combine the assets of hundreds or even thousands of plans into a common portfolio. Typically, a 12-month put applies, but the market is evolving to include new and innovative structures like we discussed earlier. So to wrap this up, an important part of the stable value selection process is understanding these differences across the categories and then working with stable value providers who have experience and success managing stable value assets through varying market conditions.
Well, Matt, I got to say, it's been very educational for me. Matt Condos with Lincoln Financial. Thanks for joining us today and sharing your insights on the 401k Specialist podcast.
Yeah, thank you. I really appreciate your time and opportunity to discuss stable value with you.
Brought to you by Lincoln Financial. For more than 40 years, Lincoln Financial has pursued a risk-controlled approach to stable value management that has proved attractive to plan sponsors and participants seeking stability, liquidity, yield, and principal protection from their stable value funds. For more information, visit lincolnfinancial.com/SVIO.